This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Hurricane hit. Harvey and Irma take a bite out of the U.S. labor market, leading to the first month of job losses in 7 years. But there was plenty of good news, too, in this month's jobs report.
Stacked chips. This week's Market Monitor has 3 blue chips that he thinks you need to own right now.
And staying on course. How one entrepreneur is on a mission to fix what some call the broken business of student loans. All that and more for Friday, October 6th.
Good evening, everyone, and welcome. For the first time since 2010, the U.S. economy lost jobs. Most of the losses trace back to the hit from Hurricanes Harvey and Irma. And while many see the decline as a short-term blip, it did catch forecasters by surprise. In September, the economy shed 33,000 jobs, while economists were looking for a gain of 80,000. The unemployment rate did dip to 4.2%, the lowest since 2001. And as Hampton Pearson tells us, there are other bright spots in the report as well.
Hurricanes Harvey and Irma, which closed thousands of businesses in Texas and Florida, ended the 83-month streak for job gains. And the loss of 33,000 jobs in September was the first monthly decline in nearly 7 years. Restaurants and bars took the biggest storm-related hits, shedding 105,000 jobs. Dallas Fed President Robert Kaplan sees the setbacks as temporary.
We knew that the September number was going to be affected by Harvey and to some extent Irma, and it has been.
But there were also signs of underlying strength in the job market. The unemployment rate fell to 4.2%, the lowest in 16 years.
The unemployment rate is a number that really got my attention because the BLS said that the survey wasn't really disrupted by the hurricanes. They said that the response rate was in line with normal, even in the areas that were affected by the storms.
And there was a spike in wages. Average hourly earnings up 0.5%, 2.9% year over year to nearly $27 an hour. The government says that wage growth may be artificially inflated because so many low-paid workers were out of work in hurricane-hit areas. But a leading Wall Street economist says upward revisions on wage growth in July and August support the overall trend.
I think the most significant part is actually the upward revisions to wages in July and August. That's a cumulative 0.3 percentage point.
It is that spike in wage growth that has most Fed watchers predicting another interest rate hike before the end of the year.
The big theme that's coming out of this is we've seen interest rates actually rise off the back of it. The probability of a Fed rate hike in December has gone up.
The Labor Department says when you add it all up, 1.5 million people were unable to work last month because of the weather, the biggest setback in 20 years. And yes, a hiring rebound is expected as those hurricane-impacted areas recover. For Nightly Business Report, I'm Hampton Pearson in Washington.
Let's turn now to Seth Carpenter for more analysis on today's jobs report. He's the U.S. chief economist at UBS. Seth, welcome. Good to have you with us. I was speaking earlier today to a former mayor of New Orleans who said, hey, yeah, that's right. It was kind of an aberrant report. The hurricanes had something to do with it. But pay attention here. We may be at some kind of inflection point. Do you agree or reject that thought?
So neither, actually. I think it's really hard to tell from this month's report any important trend in the data. We knew that there was going to be a lot of noise coming in because of the hurricanes, and that's really the way we see this whole report. It's much too noisy to draw any true signal from.
So what does that mean, Seth, for the Federal Reserve, who watches that type of report very carefully in terms of, you know, the wage issue, the participation rate, all of those different things? If it's a somewhat muddied report, does it matter less to them this time around or not? What do you think?
Yeah, no, I think this time it probably does matter less than it does usually. The labor market report is traditionally just a very, very important report. It tells you about jobs, which reflects on the health of the economy. It tells you about wage inflation, which is giving you signals about how tight the labor market is. But this time it really is pretty noisy. Our view is that the Fed already has a forecast that inflation is going to be rising gradually, and so we already saw them hiking rates again in December. this report is not going to change their underlying forecast, and as a result, it doesn't change our view that they're going to hike in December.
So let's drill down on one little piece of it, and that would be the wage growth number, which was fairly healthy, fairly robust, comparatively speaking, up 2.9% year over year. Was that number too sort of contaminated by the noise, as you say, of the month?
We think it was contaminated. I think some of the stories that you'll hear that we're sympathetic to are that some of the lower wage workers probably were out of work during the survey week, and as a result, you're getting an upward bias, at least for this month's data, in terms of the wage inflation. So we think you can discount the strength that we're seeing there, at least somewhat.
How does the overall economy look to you, Seth?
So that's helpful, and regardless, even without a hurricane, any single month's worth of data is not going to be pivotal in terms of your view of the economy. So looking over many, many months, in fact, over years, the economy has been creating 150 to 200,000 jobs a month, and those are just really solid numbers, both a reflection of a strong economy. A healthy economy creates jobs, but also a driver of the economy, because with more jobs being created, there's more household income, and household spending is about 70% of the economy. So we feel like the economy is on solid ground. It's doing well. It's not gangbusters, but it's pretty solid.
Seth, thank you so much. Have a great weekend. Seth Carpenter with UBS.
To Wall Street, where stocks mostly ended the day lower after that soft jobs report. The S&P 500 snapped its 8-day win streak, its longest in 4 years. The Dow lost almost 2 points to 22,773. The Nasdaq scratched out a gain of nearly 5, and the S&P dropped about 3. But it was a good week for the averages, with all adding more than 1%. Energy, though, is something to keep an eye on as Tropical Storm Nate threatens the Gulf Coast this weekend, and companies have already started shutting down offshore oil and gas rigs.
Well, this year has been a strong one so far for stocks, with some dubbing it an all-gain, no-pain market. The question now is, does this continue, or are we hitting a point of it's as good as it gets? Mike Santoli examines.
Call 2017 the year of the all-gain, no-pain stock market. The broad S&P 500 index has climbed 14% this year, with only a brief dip of about 3% along the way. That's nearly 5 points of reward for each point of downside risk, making this one of the most generous market years of recent decades. Even strong rally years typically feature one or more setbacks of at least 5% along the way, with 10% drops happening in a majority of years. The lack of volatility this year makes 2017 resemble such winners as 2013 and 1995. When stocks rose 30% in remarkably gentle fashion. This year, a global pickup in economic growth, stubbornly low interest rates, and record corporate profits help explain stocks' orderly advance. The lack of progress to date on tax reform in Washington has been taken in stride. In fact, those impressive rallies of 2013 and 1995 also occurred in years of D.C. gridlock, with government shutdowns and stalled fiscal agendas. So what does this steady, relentless rise suggest about the outlook for the fourth quarter of 2017 and beyond? Well, for one thing, history tells us this is not the way stocks tend to behave right before a serious peak. Markets tend to get jumpy and unstable ahead of a major correction or the end of a bull market, so the next 5% pullback is unlikely to be the big one. In fact, stronger economic data combined with a slow pace of Federal Reserve rate increases is prompting predictions of a so-called melt-up, as professional investors rush to get into a market that has furnished few dips to buy at lower prices. That said, fresh concerns are surfacing. One is the chance the Fed might move faster in lifting rates in response to a hotter economy and a pickup in inflation, perhaps under a new Fed chairman early next year. Also raising some alarms, investor optimism may be approaching a short-term extreme after several successive all-time highs in the indexes. While neither of these worries suggest this bull market is in danger of expiring, they could jolt the market in coming weeks or months and perhaps inflict just a bit more pain to offset some of the market's healthy gains. For Nightly Business Report, I'm Mike Santoli, the New York Stock Exchange.
Despite today's employment numbers, a new wave of innovation technology is creating opportunity for job seekers. Kate Rogers shows us why one Dow component sees it as the next big thing.
In middle school, Eileen Lowery swapped band for a computer science class and hasn't looked back.
I've always been fascinated with how do things work.
Today, Lowery runs one of IBM's North American blockchain programs.
Every day I'm talking to clients, working with them on building their blockchain applications and figuring out what good use cases exist for them in their industry.
Blockchain is a record of transactions, a transparent and tamper-proof digital ledger that allows users to share information quickly, freely, and without fear that it could be altered without users detecting it.
It's really the second wave of technology innovation since the time of the internet. It's addressing a lot of issues that robotics cannot address today, primarily because blockchain is addressing the underlying data that is used in our processes.
Blockchain makes that data permanent and immutable, increasing the level of confidence and reducing costs. Companies across a wide range of industries, from financial services to logistics, retail, and more, are betting big on the future of blockchain, and IBM is among the leaders.
When you think of making the complex very simple, that's what we look to do in both technology and business.
They're currently working with some of the leading food suppliers like Walmart to help address food safety challenges.
It's still a complex network getting, let's say, a mango from the farm to the fork. There's lots of exchanges in there. And right now, that causes lots of challenges and trouble with regards to that food safety.
IBM employs more than 1,500 people to help clients build blockchain-based solutions, and as its business grows, the company is looking to hire additional talent.
What we look for are people who are ready to move quickly, think creatively, and be very close to our clients.
IBM is ready to train the right candidates.
Blockchain is a new technology, so finding people with experience and expertise in the enterprise is not easy. So we do look at a lot of adjacent skill sets, so software development, cybersecurity, cloud development.
IBM also considers new-collar workers, people without a 4-year degree in IT, as well as veterans. For Nightly Business Report, I'm Kate Rogers, New York City.
Big and ugly. That's what this week's Market Monitor calls the stocks he thinks would be beautiful in your portfolio. He'll tell you which ones they are coming up. Well, yesterday we told you Constellation Brands raised its full-year guidance on the back of stronger beer sales in the third quarter. Now, this was a glimmer of hope for the fizzy stuff, which has been a bit of a buzzkill for the industry as more people turn to wine or liquor. Landon Dowdy is in Denver. She got the assignment with a look at what companies are doing to compete for beer.
It's the Super Bowl of the beer industry, the Great American Beer Festival. The 60,000 people expected to attend this weekend stormed in the door at the kickoff last night, and more than 800 brewers, like Colorado's oldest brew pub, Wynkoop, are here pouring their latest brews to stand out in a competitive marketplace.
We experiment a lot. We brewed a beer recently with yams and marshmallows. We also have a beer we've made with donuts and coffee. Cucumbers and black sea salt. We're trying to use as many interesting ingredients and inspirations as we can.
You wouldn't have any idea by the looks of the scene, but the beer category is struggling. Overall beer sales were flat for 2016 and have been on the decline so far this year.
Wine and spirits are definitely cutting into beer's share of total alcoholic beverage. Nobody's really loyal to a specific type of alcohol any longer, be it spirits, wine, or beer. And I think that's had an impact over the last 15, 20 years on beer's overall market share.
So with spirits and wine killing beer's buzz, brewers are having to adapt and get innovative.
The consumer wants more flavor and more variety than ever before, and we're seeing companies respond. There's more options. People are experimenting with one-offs, with brands that change, constantly by the season. I think the other thing is clearly beer lovers want that experience now. They want to connect with brands. So ways that you can engage with beer lovers rather than just offering them a product, but give them experience.
While trends haven't been positive, don't rule beer out just yet. We are starting to see signs of hope. Q3 showed signs of growth year over year, and 800 brewers are here pouring their brew this week, and a record 5,700 breweries are operating nationwide, investing in businesses and betting on beer's turnaround.
And craft brewers like Wynkoop are finding ways to stand out. out. They've adapted a seal of independence along with 2,300 other craft brewers to let consumers know what they are drinking is truly craft. The seal is a response to big beer companies like Anheuser-Busch and others buying up more than a dozen craft breweries in the past few years to mass produce. But does the seal actually impact the purchase power to help consumers know that they're supporting the little guy?
I don't really care. I'll try out anything.
Sure, I mean, if I'm somewhere else and I see, I'm not familiar with any of the local beers, absolutely, I'd say, yeah, let me get a craft beer instead of some mass-produced stuff that I don't really like anymore.
At my job, it's kind of nice because it's like things that you might not taste anywhere else. It could be a one-time thing. There's not necessarily consistency when you get that.
While the jury is still out on the impact of the consumer choice since the seal was enacted in July, analysts say it might make a difference, but with a very niche group of beer consumers.
Cheers, everybody! Cheers!
For Nightly Business Report, I'm Landon Dowdy in Denver, Colorado.
Amazon is reportedly close to deciding whether it will get into the prescription drug business, and that's where we begin tonight's market focus. According to CNBC, the e-commerce company will decide by Thanksgiving if it will start selling prescription drugs online. Previous estimates pegged that time frame within the next year or two. Analysts have estimated that market to be worth more than $500 billion a year. That news sent shares of pharmacies CVS and Walgreens and pharmacy benefit managers Express Scripts lower. Amazon finished slightly higher. Data center operator Switch went public on the New York Stock Exchange today, pricing more than 30 million shares at $17 apiece. That was above the expected range. The offering values Switch at more than $4 million. Shares soared more than 22% in their debut, closing the day at $20.84. And the cereal giant Kellogg is buying protein bar maker RX Bar for $600 million in order to expand its product portfolio. Kellogg hopes the move will help it attract more millennial customers, saying that generation is big consumers of that brand. Kellogg shares fell fractionally to $62.40.
Flexion Therapeutics says the FDA has approved its non-opioid treatment for osteoarthritis knee pain. The drug maker said it will be available in the U.S. later this month. Shares of Flexion up 10% to $29.93. The personal care products company Helen of Troy reported results that beat analyst estimates, but investors were disappointed to hear that Troy was cutting its full-year forecast to restructure its business, and shares went to Helen in a handbasket. They fell more than 9.5% to $87.80. And late today, Tesla CEO Elon Musk said the automaker will delay the unveiling of its electric truck to next month. Musk says the company is focusing on fixing Model 3 production bottlenecks and increasing battery production in Puerto Rico. Tesla shares were initially lower after Musk's announcement. They finished the regular day up fractionally at $356.88.
Time now for our market monitor, who says now is the time to be a buyer of these big cap stocks with yields higher than U.S. Treasuries. The last time he was on in March, he recommended D.H. Horton, which is up 24%, Toll Brothers, which is up 20%, and Lennar is 8% higher. Joining us is Chris Bertelsen. He is the Chief Investment Officer at Aviance. Nice to have you back, Chris. Welcome.
Thank you. Glad to be here.
You say that your stock picks, which we'll get to in a second, are unloved, unwanted, and had been underperforming, but you think that they're a good addition to the portfolio, correct?
Absolutely. You felt a little pain with owning these over the last 4 to 5 years, but that's about to change, partly because they all pay great dividends, and they are really in the stages of transformation in major ways.
You have 3 picks that nobody in the audience will ever have heard of, Chris. Let's start with one of them, AT&T. Why do you like it?
Tyler, 5% dividend yield when there's 1% CDs out there, so certainly you're getting paid while you wait. And I think everybody knows that they pay this bill before they even pay their mortgages now. So you know that it's going to be around in 4 or 5 years. They're solely going to increase their dividend. And the integration of Time Warner, which is a big step for them, is going to make them a far more interesting media company than they are now.
AT&T is next, or I'm sorry, Walmart is next on the list. We just did AT&T. Walmart, you say it's time to sell Amazon and move into Walmart.
Absolutely, Sue. You know, Amazon is a great company, but look at all the things they're getting involved in, from groceries on down the line to just what I heard now with pharmaceuticals. And, you know, you look at it and you say, this is going to cost them a lot of money. Whereas Walmart has been in the grocery business for years. Plus the fact Walmart pays a very robust dividend that they raise almost every year, or have been raising every year. And Walmart knows how to compete. They are the ultimate systematic cheapskates. And I think that Amazon is going to have real competition with Walmart.
And you say, finally, time to sell some Apple and buy IBM. That is a much unloved stock. So unloved, I think, that Warren Buffett even dumped it.
Yes, he did. However, you know, IBM, Gina Rometty has done a terrific job. They've changed from this big company orientation systems back to really the consumer. And you see that with their Watson type of apps and all of their doing on the basis of the cloud and everything. Maybe a little late to it, but you're getting paid 4%. The stock is super cheap. And I think they're under a real transformation in going back to their roots.
And the exchange rate, you say, will work in their favor as well.
Absolutely, all of them.
All right, on that note, Chris, thank you so much.
Thank you.
Chris Bertelsen with Aviance.
And coming up, helping manage the debt load from student loans for those still in school and those who are already out.
And here's a look at what to watch for coming up next week. On Tuesday, we will get the minutes of the last Federal Reserve meeting. As usual, the market will be paying close attention to anything related to possible timing of future interest rate hikes. Inflation in focus at the end of the week with producer and consumer price data out. And believe it or not, we're there again. Earnings season is coming. The banks get the party started when Citi and JP Morgan release results on Thursday. And that is what to watch next week.
The most wonderful time of the year, earnings season. All right, student loans, well, they're the second largest source of debt in our economy, trailing only mortgages. 44 million people and counting hold, believe it or not, $1.4 trillion worth of student loans. And that's why one entrepreneur got the bright idea to give borrowers a better shot at lower rates and a guiding hand toward being able to manage their debt better.
For 5 years, Alex Kubo put his startup dreams on hold, working at ExxonMobil to pay off roughly $40,000 of student debt.
Ended up going to whatever company could pay me the most amount of money.
Kubo's worked hard to manage his loan situation. Entering business school at Wharton in 2015, he found Common Bond, a private online lender started by Wharton students. He locked in a 5.9% rate on a $70,000 loan.
We save our borrowers on average about $20,000+.
David Klein got the idea to offer lower rates and better service in 2011 as he entered Wharton with loans of about $90,000.
The market itself is pretty broken. High rates, complex process, poor service.
10 years earlier, Klein consolidated his college loans with the federal government at about 2%. But the game changed after 2010 when the government stopped guaranteeing loans by private lenders. 8% rates were common.
If consumers are paying 8% and investors are receiving 2%, there's a lot of room to provide more value to the consumer by lowering their rate, to the investor by increasing their return, and then eke out a modest profit in between.
Klein won't say if Common Bond is profitable, only that it began by making $2.5 million worth of loans to 39 Wharton students in 2012, went national a year later, and now it's doing direct loans and refis for students at more than 2,000 schools.
We have lent over $1 billion to tens of thousands of people.
Margins are improving. Early on, Common Bond paid investors 5% for loan capital. Now it's about half that, but still more than the big banks pay. Klein says Common Bond beats its competition on operating costs, has no bank branches, for example, and its high credit, low-risk customers rarely default. That's partly due to the effort it makes to communicate and keep them on track.
You'd be shocked to realize that over 95% of the people who go through that process, even MBA students, don't know exactly what their monthly payment's going to be.
Oh my God, I don't like this.
Which is why 1,000 high schools are using a new video game, Payback, to simulate college costs. It's the brainchild of financial educator Tim Ranzetta.
You'll see many financial service firms providing financial education. What I think is lacking overall, 1 in 6 high school students graduates with a personal finance course. That, for me, is the biggest issue.
It's an issue Alex Kubo values too. He's now at the New York startup Burrow, an online furniture retailer, but he traveled to Ghana last year to see how, for each loan it makes, the company is funding a year of study for a student in a developing country.
Building schools, providing opportunity, made me feel a lot better about the fact that I owe these people a lot of money.
Feeling good about a lender? Now that's a new one.
A lot of the big folks out there don't seem to make the connection between treating the customer really well and having a long-term sustainable business model.
Interesting business model. Like a lot of companies these days, Common Bond offers a benefit to help its own employees pay down their student debt, and it's been partnering with other companies looking to do the same.
Well, before we leave you, let's take a quick look at the day on Wall Street. The S&P 500 snapped its 8-day win streak, its longest in 4 years. The Dow lost almost 2 points to 22,773. The Nasdaq scratched out a gain of nearly 5, and the S&P dropped about 3 on the trading session.
And that'll do it for tonight's edition of Nightly Business Report. I'm Tyler Matheson. Thanks for watching.
I'm Sue Herrera. Have a great weekend, everybody. We'll see you right back here on Monday.